You may have built up a bit of wealth, some in pensions, ISAs, maybe some cash on the side. But the big question isn't just how much have I got, it's how do I make it last in retirement through market crashes, inflation, and real life events. To bring this to life, I'll introduce Amelia, a 56-year-old project manager who wants more life and less of the corporate grind. The numbers and choices are different to every person, but the principles we'll cover apply to almost everyone considering early or flexible retirement. So Amelia is 56, and after years of working in a high-pressure project management role, she's beginning to question whether she wants to keep going at this pace. Over time, she's built up a solid financial foundation. So around $380K in a workplace pension, invested in a fairly balanced default fund, $120K in a cash ISA, and around $25K in cash savings split between easy access and short-term fixed interest accounts. So altogether, she has around $500K tucked away. She earns £68,000 a year, but the long hours and constant pressure have started to wear thin. With regards to future income, she has a full state pension record too, which means she'll qualify for the full amount when she turns 67. She owns her own home outright, a 3-bed property worth around $525K, and she's perfectly happy living there for the long term, with no immediate plans to downsize. Right now, Amelia's monthly spending looks pretty typical. About £2,000 on essential costs and £300 on lifestyle spending. She's also dreaming of making the most of her early retirement years, so she would like to spend an extra £500 a month on travel and expenses from when she retires to age 75. So starting retirement expenditure will be around £2,800 per month. Ultimately, her ideal scenario is to leave the corporate world this year. In fact, she would like to know how her situation would look if she had to retire in 1 month's time. If that's not quite possible, she'll be very happy shifting to a 3-day work week, doing something lighter and more enjoyable. So we start by modeling Amelia living to age 95, keeping her spending in real terms after inflation and using her current investment allocation in her pension. From this, we calculate an initial retirement score of around 70%, which simply means that based on her pension, ISA, cash savings, and future state pension, she's currently on track to meet only around 70% of the income she wants in retirement. In other words, she needs around 30% more in her pension, ISA, and cash savings to fund the rest of her retirement. Put another way, if Amelia stopped working right now, she will very likely find herself needing to trim her spending quite dramatically in retirement, or even considering going back to work. The projections show her pension, ISA, and cash falling quite sharply and even running out towards her late 70s, which naturally raises concerns when you're looking ahead to a long retirement. The main reason her plan looks a little under strain is timing. By retiring at age 56, she faces an 11-year period before her state pension begins at 67. During those years, her investments are covering everything, and that puts a lot of pressure on the portfolio. So when we look at her withdrawal levels, the picture becomes clearer. The withdrawals leading up to age 67 are quite substantial, and her initial withdrawal rate of nearly 7% is simply too high to sustain over multiple years. And that's what creates the projected retirement shortfall shown in the charts. And this is the income gap that could stretch for up to 20 years if nothing changes. So at a headline level, if Amelia retires now and aims to spend around £2,800 per month, it's unlikely her savings would sustain this comfortably through a long retirement. The encouraging news is that Amelia is open to exploring different options, including part-time work, and wants to understand how these choices could strengthen her long-term financial position and what a realistic path forward looks like. So let's have a look at applying some strategies that could potentially improve her retirement outlook. The first option is delaying full retirement by a year, which gives Amelia a surprisingly strong boost to her long-term plan. So taking an extra year to work provides that continued income, ongoing pension contributions, and 1 fewer year in which she needs to draw from her investments. This combination has a powerful compounding effect. Her retirement score improves quite noticeably, and her projected shortfall, so the number of years where savings would not fully cover her desired spending, reduces from around 20 years to roughly 15. So many people often are quite surprised by how 1 additional year can reduce several years of financial strain. But the maths is quite simple. So more going in terms of pension contributions and less coming out, and more time invested. The second strategy Amelia is open to is part-time work. She just wanted to get out of the corporate world and did not mind doing something else that she really enjoyed. So she decides to work a 3-day week from age 57 to age 62, which gives Amelia a balanced way to ease into retirement, while significantly strengthening her financial position. By working part-time and earning around £24,000 per year, she can reduce the amount she needs to withdraw from her investments during these crucial early years. This lighter withdrawal pressure allows her portfolio more time to grow. As a result, her retirement score improves to 89%, and her projected retirement shortfall drops to just 6 years. The reason this works so well is simple: taking fewer early withdrawals and keeping more of the portfolio invested for longer. And this creates that better outlook and long-term flexibility. Now, turning to Amelia's investments, we noticed that her workplace pension was still invested in the default fund selected by her employer. While this is common, it wasn't ideal for Amelia's goals. The fund was gradually shifting away from growth assets into more conservative holdings, which doesn't align with her long-term growth she needs for retirement that could last 30 years or more. After reviewing her objectives, we recommended a slightly higher risk growth-focused investment approach and moved her pension accordingly. This adjustment alone increased her retirement score to 94%. Now, Amelia also holds around 120k in cash ISA. Given that she doesn't need this money in the short term and already has 25k set aside as an emergency buffer, we recommended transferring this cash ISA into a stocks and shares ISA and investing in the same balanced, growth-orientated portfolio as her pension. With this change, her retirement score increases further to 106%, giving her a financial cushion of around 6 years rather than a projected shortfall. The final strategy focused on making Amelia's retirement income as tax efficient as possible. When she begins taking money from her pension and ISA, the goal is to structure withdrawals in a way that keeps her tax liability as low as possible. This includes staying aligned with current tax legislation and planning how best to use options such as phased tax-free cash, lump sum withdrawals, and the balance between taxable and tax-free income each year. And by optimizing the order and structure of withdrawals, Amelia retains more of her wealth over time, and this approach creates a modest but meaningful improvement in a long-term position, increasing her retirement score to 107%. Up to this point, we've looked at Amelia's plan using a simple, steady return of 6% a year. Helpful, but not how real markets behave. In reality, returns are not consistent. We may get 7% 1 year minus 2%, and those early years in retirement matter most. This is what we call sequence of returns risk. To see how Amelia's plan holds up in the real world, we run a volatility analysis. And this models 1,000 different market scenarios each year, with good years, bad years, and everything in between. So in the year she retires, all 1,000 scenarios show she can comfortably cover her spending. But as we move further through retirement, this success rate gradually drops. When fewer than 75% of simulations succeed, the bars turn orange. Below 60%, they turn red. The first red bars appear around age 91. Now that might sound concerning, but it's important to keep perspective. The risk only appears very late in life, and most people naturally adjust their spending well before then. So small changes, less travel, fewer big expenses can easily pull the plan back on track. But ultimately, it comes down to what Amelia feels comfortable with, knowing that she's got the flexibility to adapt if needed. Amelia's plan shows that retiring in her late 50s is possible, but it's not a straight line. A small delay to fully stopping working, a short spell of part-time income, better investment decisions, and drawing money in a more tax-efficient way all make a real difference. And when you put these changes together, her retirement outlook moves from looking a bit fragile to feeling generally comfortable with a proper buffer built in. And even when we stress test the plan against poor market conditions, it still holds up for the most of her retirement. And if you'd like to see these numbers modeled using your own pensions, savings, and goals, feel free to get in touch. I'll be happy to help you build a plan that supports the retirement you want. See you in the next video.